Understanding the difference between capital improvements and repairs could save you tens of thousands of dollars and even prevent an IRS audit. This difference between them is a vital part of your rental property accounting, but it's also one of the least clear-cut parts. This is because the IRS treats the two very different tax purposes, but there are scenarios where a repair might in fact qualify as a capital expense and vice versa. Hey, I'm Logan Ransley, co-founder of Landlord Studio, the #1 rated property management and accounting software on the market. And today I'm breaking down the difference between capital improvements and repairs. Before we dig in, make sure to hit that subscribe button and ring the bell so you don't miss any of our money-saving tips. So here's the thing, the IRS treats capital improvements and regular repairs completely different. Get this wrong and you'll end up either overpaying your taxes or setting yourself up for audit issues down the road. But differentiating between the two can be quite difficult. The IRS has a list of tests you can run, and even they admit the lines can get a little muddied at times. It's not just a case of whether an expense is above a certain threshold or if the work is a kind of certain work, but it actually comes down to the most importantly, whether the work adds value to the property beyond the original value, or whether it returns it to original value. And at times, this can be more of guesswork than science. Let me explain what I mean. In short, a repair is anything that maintains your property in the current condition or restores it to its original state. Examples might include repainting walls, fixing leaky faucet, replacing broken hardware, air conditioning maintenance, repairing a broken window, or routine landscaping. On the other hand, a capital improvement is a permanent fixture that becomes part of the property and either enhances your property value, extends its useful life, or adapts it to new uses. The IRS considers something permanent if removing it would cause significant damage to the property. It's attached or built into the structure, and removal would substantially decrease the property's value, or it's intended to remain the property indefinitely. For example, converting a garage into a separate rental unit, renovating the bathroom, installing a new roof, upgrading to high-end appliances throughout, or adding essential air conditioning where there wasn't before. Now, before we get into some of the grey areas, we want to explain why this distinction is so important in the first place. It all comes down to when and how you can deduct these expenses. Regular repairs and maintenance are what are called operating expenses or OPEX. And the beautiful thing about this is that you can deduct them immediately in the same tax year you incurred the expense. If you spend $500 fixing a water heater, you can deduct that full $500 this year, for example. Capital improvements, on the other hand, are capital expenditures or CapEx, and you cannot deduct these full costs in the same year you make the improvement. Instead, you have to add these expenses to the cost basis of the property and depreciate them over time. Now, for residential rental properties, you can depreciate these over 27.5 years. Commercial properties, it's 39 years. So let me give you a real example. Say you convert the room above your garage into a self-contained short-term rental with an ensuite bathroom and a kitchenette, and it costs $50,000. This qualifies as a capital expense because it's permanent and you've changed the use of the property and you've increased the property's value. As such, you can't deduct that $50,000 in this year, and instead you have to add it to the property's cost basis and depreciate over 27.5 years, which comes to roughly $1,800 per year, which means you might never recoup that investment through your taxes. Now, there are a couple of silver linings. For example, there are several tax strategies where you can accelerate that depreciation using cost segregation studies and IRS safe harbors, but that gets pretty technical and is different for every situation. So we'd advise you to go discuss that with your CPA. And there is another silver lining, cost basis advantage. While capital improvements might delay your ROI, if managed right, they do also come with advantageous tax treatments of their own. Capital improvement increases your property's cost basis, and this in turn reduces future capital gains liability. Now let's break that down into another example. So you bought a rental property for $200,000 and then later you do $20,000 in capital improvements. Your adjusted cost base is about $220,000. Fast forward 10 years, you sell that property for $250,000. Without those capital improvements, your taxable capital gains would be about $50,000. But with them, your gain is only $30,000. That means there's a $20,000 difference, and that's what you're paying capital gains on. Now, depending on your tax bracket, that could save you $3,000 to $6,000 or more in taxes when you sell. And plus, those capital improvements help with something called depreciation recapture. Now, when you sell a rental property, the IRS wants to recapture some of that depreciation you've been claiming. And a higher cost basis means less depreciation recapture tax to pay overall. And if you get it wrong, you might not be able to take advantage of this tax treatment at all. And this is why keeping detailed records of all your capital expenses is really critical. We're talking receipts, invoices, before and after photos, everything. And the best way to do that is with software like Landlord Studio. Now the gray areas. So far, this might sound relatively straightforward. You add an extension, you add that to the cost basis, depreciate it, and then deduct it from your capital gains. But sometimes what starts as a repair becomes a capital improvement. And miscategorizing them can actually get you into real trouble. Picture this, you call a plumber for a leaky pipe. On any other day, this would be a simple repair. But then the plumber discovers extensive hidden damage. They need to replace a huge section of piping, and in the process, they have to tear up and replace your entire kitchen floor. Fixing the pipes, that's a repair, but placing the whole kitchen floor, that's likely a capital improvement because you're installing something that adds value to the house. And in fact, any repair and involve replacing over a third of the major components is generally considered a significant portion, making the expenditure capital improvement. Now here's another tricky one, painting. Generally, painting is a regular maintenance expense that you can deduct immediately, but the IRS has an exemption. And if you're doing a comprehensive restoration like this, replacing a roof, for instance, new windows, HVAC, painting, and it's all part of that, then painting actually becomes part of the capital improvement package. The key question here the IRS asks is this actually a part of a larger improvement project? And if it is, are they all considered capital improvements? Final example, repairs being treated as capital improvements is whether they take place before the property is placed in service. Now, the IRS considers a rental property original condition to be the state at which it was first placed in service. That's when it was ready to rent. And any work done prepared on the property for its first rental use, even minor cosmetic updates like painting or small repairs, is all treated as capital improvements, not deductible repairs. And once the property is placed in service, however, the future repair or maintenance costs are generally deducted in the year they occur. It's all part of that. So how do we track all of this? This is where it becomes really important, and having the right property management and accounting system in place is non-negotiable. Here's what you need to do to maximize your rental property expenses and repair tax benefits. First, create separate categories in your accounting system for capital expenses and regular repairs. Don't just throw everything into one place and say it's all property management. Secondly, save every single receipt. I mean everything. The IRS has specific documentation requirements, and you don't want to be scrambling if you get audited. And third, take the photos, before and after shots of capital improvements. They're all gold when it comes to this because it just increases your chance and documentation. And then fourth, use proper accounting software like Landlord Studio, which makes everything categorizing, tracking just much easier. Landlord Studio has features like receipt scanning, automatic bank feed integration, and built-in reporting that just separates and helps you keep all the CapEx and OpEx all organized. And trust me, when tax season rolls around and when you sell that property, your future self is going to be very thankful. Now remember, the difference between a repair and a capital improvement isn't always obvious, but getting it right can save you thousands or even tens of thousands of dollars over the life of your investment. The key takeaways here: first, ask yourself, am I adding value beyond the original condition or simply maintaining what's already there? Second, if you're planning any major work on your properties, consult with a CPA or a tax professional before you do the work. They can help you structure the project in certain ways, keep it tax efficient. And then third, set up the proper tracking systems if you don't already have one. Even a simple spreadsheet is better than nothing, but I highly recommend dedicated rental property software like Landlord Studio. Now, if you found this video helpful, click that like button, drop a comment below telling me, what property expenses you've been unsure about. And again, thanks for watching, and I'll see you in the next one.